Okay, well, Adrian Mowat is now joining us, investor at the Hong Kong is here. Adrian, good to have you back on the program. Thanks very much for your time. Appreciate it. So, let's just kind of, since you're back after a long time, let me ask you where you're at in terms of your thought process of what global markets have in store for us in the near to medium term. How is data looking to you? And what's the most dominant theme which is likely to play out? Go on.
So we're seeing major equity markets do well. So we've had good year-to-date performance out of the US, Europe, and Japan, with Japan making multi-decade highs. And what seems to be going on there is that the large cap stocks in these markets are doing things like cutting costs, they're generating more free cash flow, and they're proving to have revenues that are a bit more resilient to some of the sort of macro headwinds that are out there. We've got much debate about what's going on in the interest rate outlook, in particular bond markets. We have the most inverted bond yield curve that we've seen since the Volcker years. Now, remember when Volcker was chairman of the Fed, he put the upper band of the Fed fund target rate up to 20%. So if we think about the inversion in the yield curve today, where you've got short-term rates at 5.25 and 10-year rates at 3.5, it's probably the most extreme in a geometric measure rather than arithmetic measure. So that leads to this very powerful, consensus around that there's going to be a recession. And that makes buying risk assets quite tricky because, if the consensus is very bearish, there's quite a good chance that you move up a wall of worry. Now, near term, we have obviously a major event, which is the US debt ceiling. The US debt ceiling has forced the US president to cancel his trip to Australia and Papua New Guinea that he was planning. And maybe that's a good thing if they're really focused on trying to resolve this. So I think we've got a really quite a complex outlook. Let's throw into what's going on within emerging markets. Emerging markets have been disappointing year to date. There has been disappointment around the most recent China data. Although when you look at the stats, the economic surprise index in China is almost at its record high. It was previously higher back in 2006. So, to some extent, I'm a little bit surprised that people are so downbeat on the China data. And then finally, when we look at some of the other emerging markets, there's a fair amount of event risk out there with elections in Thailand and also elections in Turkey, and the Turkish elections going to a second round. So complex out there, but I think the story is very much one of large cap stocks in the major markets, which are proving to be more defensive.
Adrian, hi, good morning. So you're saying that, look at large cap stocks in any market that you're operating in, because, and especially the ones that are defensive. Got it. Given the scenario and the expectation of a recession in the US, how are you approaching markets like India? Because now we've seen some money come in thick and fast, especially from the foreign fraternity. I mean, it's been 14 straight days of large money into the Indian markets. Has confidence returned because valuations are looking more attractive than they did 6 months ago? Or is growth picking up here? And what is your own view on India now?
So I think what investors are seeing, is a trend. So there's a trend, whether it's the financials or the autos in India. So that's a positive statement on domestic consumption. And the drag on the indices has been from the likes of the Adani group, from Infosys, from Cipla, from Hindalco. If you strip these out, India's year-to-date performance would look almost on par with some of the major markets, such as US, Europe, and Japan. So I think investors are seeing a theme. They're not anxious about the macro outlook in India, so are willing to play selective themes in that market.
Hi, Adrian. Good morning. When we last chatted, I think China, Taiwan, as well as Korea, if I remember correctly, they were coming ahead of India in the pecking order. Has that changed now? India has gone through a bit of a time-wise correction as well.
Yes, so we've got China and India sort of neck and neck at just up 1% if you look at the broader indices. But I would suggest that at the margin, macro concerns in China have built relative to macro concerns in India. And so, perhaps it's less competition in terms of the cash flow going into China relative to India. Now, what I would caution you a little bit on that is when you look at the large cap tech stocks in China, the numbers that came out of the likes of JD most recently, and then we've got a whole host of results this week, have actually proved to be reasonably good. And we're beginning to see some of those stocks, I think, sort of bottoming out and probably going to perform. And there is a chance that for these China tech stocks, that they do something similar that we've seen out of the likes of Microsoft, Nvidia, Tesla, Meta, etc., where there was extreme pessimism, valuations had got quite low. And actually, when the results came out, people were encouraged by those, and the results weren't a function of a very robust economy, but more about the robustness of the business and what management was doing.
Adrian, we'll leave it there. It's a good conversation as always. Thank you very much, and hope you come back soon again for more. As you said, it's a complex situation. We'll see how it resolves itself. We'll take a quick commercial break here. Our list of stocks with our research team coming up next. Stay with us.